You know, in the world of finance, you hear it all the time. Some fund manager has an amazing year, and everyone's talking. But the real question is, was that brilliant skill, or was it just plain old luck? Well, today, we're going to break down hypothesis testing. It's the powerful statistical tool that lets us get to the bottom of it and separate what's real from what's just random chance.
So here's our game plan. First, we'll tackle that core dilemma, luck versus skill. Then we're going to step inside what I like to call the statistical courtroom and learn the rules of the game. After that, we'll see those rules in action and actually put a fund on trial. We'll even explain the toolkit a bit. And finally, we'll get to the final verdict on why all of this really matters for any serious investor.
All right, let's kick things off with a problem that is, without a doubt, at the very heart of financial analysis. It's that classic question every single analyst has to grapple with when they're staring at a performance chart.
Okay, picture this. You're looking at a fund and its returns have been incredible. Your gut is screaming, this manager is a genius. But, gut feelings just don't fly when real money is on the line. What we need is a tough, objective method to really test that claim. Is that amazing performance something they can actually repeat? Or is it just a lucky streak, a bit of random noise in the market? This right here is the big question hypothesis testing was built to answer.
So to answer that question without just guessing, we need a framework. And honestly, the best way to think about hypothesis testing is to imagine it's a courtroom trial, but instead of a person, we're putting a financial claim on the stand. It's a formal, step-by-step process for weighing all the evidence before we dare to reach a verdict.
And at its core, this is all we're really doing. We're taking a little piece of data, like say a fund's monthly returns for a couple of years, and we're using that sample to make a really smart decision about the bigger picture. We're trying to figure out if the manager's true long-term ability is just average, or if there's something genuinely special going on.
You know, every fair trial has to have a starting point, right? A default position. In statistics, we call that the null hypothesis. You can just think of it as the status quo, the assumption that nothing unusual is happening. In our courtroom analogy, this is the presumption of innocence. We start by assuming the fund manager is not special, that their performance is just average. The burden of proof is on the data to convince us otherwise.
So if the null hypothesis is the status quo, the alternative hypothesis is the challenge to it. It's the bold claim we're actually trying to prove. It's the accusation in our trial. So our accusation might be, hey, wait a minute, I think this fund manager's true average return is actually different from the benchmark. And it's our job to gather enough evidence to see if we can confidently reject that presumption of innocence.
Now, just like in a real courtroom, things can go wrong. A type 1 error is like convicting an innocent person. We look at the data and say, wow, this manager has skill, when really they just got lucky. A type 2 error, that's letting the guilty go free. That's when a manager does have real skill, but the evidence just wasn't strong enough in our sample, so we miss it. You have to ask yourself, which mistake is worse? Investing in a lucky manager or missing out on a truly great one?
So, if we're running a trial, we need rules, right? We can't just wing it. To make sure everything is fair and objective, our statistical trial follows a very clear, very specific 6-step process. Every single time. And this right here, this is the universal playbook. It's really cool. First, you state your presumption of innocence and your accusation loud and clear. Then you pick the right tool for the job, your test statistic. Now here's the crucial part. Before you even look at the data, you decide how much proof you're going to need. That's your significance level. That lets you draw a clear line in the sand, your decision rule. Only then do you do the math, and finally you make the call. Did the evidence cross that line or not?
Okay, enough with the theory. Let's get our hands dirty and see how this actually works. We're going to grab a real-world example, the Sendar Equity Fund, and put it on trial right now to see if its performance is the real deal.
All right, here's the evidence file. Over the last 2 years, the Sendar Fund has averaged a 1.5% return per month. Pretty good. Now, based on its risk and style, we would have only expected it to make about 1.1% a month. So yeah, on the surface, it looks like a winner. But, and this is a big but, look at that standard deviation, 3.6%. That tells us there's a lot of volatility, a lot of noise. So is that extra 0.4% performance genuine skill? Or could it just be random chance from all that bouncing around?
Step 1 is to state our hypotheses. The null, our presumption of innocence, is that the fund's true underlying return is exactly what we expected, 1.10%. The alternative hypothesis, the accusation we're testing, is simply that the true return is not 1.10%. Notice we're not saying it has to be higher, we're just testing if it's different, which could be higher or lower.
That makes it a really fair two-sided test.
Okay, so we've set up our trial, we've decided on our burden of proof, now we run the numbers. We take all that performance data from those 24 months and we boil it all down into this one single number, 2.65568. Think of this number as the strength of our evidence. It's telling us that the performance we saw is over 2.6 standard units away from what we would have expected just by pure chance. So the big question is that far enough away to be convincing?
And that brings us to the final step, the verdict. That evidence score of 2.65568, it was strong enough to cross that line in the sand we drew at the very beginning. It's so far away from what we'd expect by chance that we can't ignore it. So the verdict is in, we reject the null hypothesis. We have enough statistical evidence to say the Sendar Fund's performance really is different from what was expected. Its outperformance is statistically significant.
Now, what's so cool about this whole framework is that it's not a one-trick pony. It's not just for putting one fund on trial. It's a super versatile toolkit you can use to answer all sorts of different financial questions.
For instance, we can use it to compare two different groups. Let's say, are U.S. hedge fund managers better than European ones? Looking at the sample, the U.S. managers did have a slightly higher return. But is that difference really meaningful? Well, we run the test, and our evidence score, our test statistic, is only 0.4893. That doesn't even come close to our critical value, our line in the sand, of 1.984. So what's the verdict? We don't have enough evidence to claim there's any real difference between the two.
And, it's also absolutely crucial to pick the right tool for the job. The tests we've been talking about are called parametric tests. They kind of assume that our data fits a nice, predictable bell curve. But what if it doesn't? Let's be real. Financial returns often have what we call fat tails. These crazy extreme events happen way more often than a perfect bell curve would suggest. For that kind of messy, real-world data, we need non-parametric tests. They're more robust because they don't need all those strict assumptions. Knowing which test to use is a huge part of the skill.
Okay, let's step back and bring this all home. We've walked through the courtroom, we've followed the 6-step process, we've even looked at different kinds of tests. But what's the final verdict? Why should this matter to you?
Here's the bottom line. Hypothesis testing gives you a structured, defensible way to cut through all the market noise and all the hype. It forces you to move beyond just a gut feeling and instead build your conclusions on cold, hard data. It's the framework that helps you see the difference between a real, repeatable signal and just the random chaos of the market. It gives you a solid, evidence-based foundation for every single investment decision you make. So this entire process, it really empowers you. It gives you the tools to be a healthy skeptic, to challenge the assumptions you hear every day, and to demand actual evidence. So I guess the only real question left is, what financial claim are you going to put on trial next?